Welcome back here with the year-end special of Money, 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 and we're coming to you from the Barking Deer in Mumbai this evening. Well, Harsh, I'm going to now start talking about products and Portfolio 2017, and I'll come back to the insurance point because I really think that it's, as I said, slightly easier to find the right fund. It's next to impossible to know if you're buying the right insurance product. Let's talk about someone who is, an urban sort of retail investor, come saver, and needs to get insurance. So what sort of products can he or she expect in 2017? Are you looking at any major changes in the industry, any changes in the product offerings in this new year?
Well, not really. In fact, we would only see, from the life insurance perspective, what I think an investor should have or an individual should have in his portfolio and should restrict it to that is a good term plan. An online term insurance policy needs to have a disability and a critical illness in his portfolio. So disability insurance would mean an accident insurance, would be critical illness would be health related disabilities.
So you're saying three different insurance plans. One would be a life insurance plan, then you need a cover for critical illness as well as disability.
Absolutely. So you can also look at some combinations available that are made available, but if you can separate them and take independent standalone insurance policies, that should be the focus.
And then where does the basic Mediclaim fall in this list?
Yeah, so this is on the life insurance perspective that I said. Now from a general insurance perspective, when you talk about Mediclaim, you talk about all the kind of non-life policies. So one is medical cover is something which is going to be paramount. I mean, because we are seeing the cost of medical treatment going up year by year and there is no control over it. On a medical, make sure that you have adequate cover. There is innovation happening there. There is a lot of, the scope of coverage is widening. So you need to be very careful and make sure that you have a good medical cover. In case you currently do not have a good medical cover, there is an option to port your policy into a new one. So as and when your policy comes up for renewal, about 45 days before that, you should look at the features available otherwise in the market. And if you're not satisfied with what you have, and if you feel there's a better offering, then you should look at porting your policy into the new.
So how does this porting a policy work, and what is the advantage of porting it out as opposed to letting one policy lapse and then applying for some other product afresh?
As against buying a new one, is what you're asking.
Yeah.
So when you buy a new policy, all your waiting periods, there is a waiting, pre-existing ailments are excluded. Then there's a specific waiting period of 2 or 3 or 4 years for any specific ailments. Now when you port your policy, you get those continuity benefits.
Okay, so no waiting periods for
the waiting
specific...
period will be calculated from the day one of your previous policy.
Okay.
So you will have a continuity benefits. If there has been any exclusions in your policy, that will continue. If there are no exclusions, then you will get that same benefit in your new policy. However, if you buy a new one, then all those conditions would start fresh. And you will not have a history to back up to, and get that coverage in future. So porting is definitely advisable in case you want to shift. If you do not have a policy, then of course you need to go and buy one for yourself.
I have two more small questions on insurance before we start talking funds. How do you rate the industry in terms of its transparency right now, in terms of its communication to policy buyers? And a quick take on, two separate areas that are very close to people's heart. One is retirement planning and all these retirement plans that are being sold by insurance companies. And the second is child planning and then child wealth plans, etc. How do you rate these two baskets and whether they are at all worth looking at, if someone doesn't have them already?
Well, I think there is a huge scope of transparency to introduce transparency in insurance field. Unfortunately, that is not the case even today. I mean, we would still see the products are still cost heavy. All the charges are not communicated effectively. Though there are regulations, there are companies and the intermediaries find a way around it. And people are invariably trapped into insurance policies.
So Feroze, same question. When you're looking at children's plans and you're looking at retirement plans, do they make sense at all to you, or would you advise staying away and looking at investments completely separately?
Yeah, if you ask me, anything beyond a term plan from an insurance company is you can do without it forever. So I personally think that trying to club objectives have been hugely detrimental to one's portfolio. So with a barge pole, you should not touch any insurance plus investment objectives combined in a child plan or anything. You're better off trying to segregate objectives.
So then, now that we've discussed protection, let's talk about creating some wealth in 2017. And here's something interesting. So for just this episode, for now, we're going to say that you're looking at an investor who's willing to take on as much risk as possible. Age is not a constraint. Other sort of liabilities are not a constraint. If you were to create a maximum wealth generating portfolio for 2017, how would you go about the asset class mix?
See, I think if somebody has to create maximum wealth, okay, so debt is certainly not going to be a portion of that. Okay, in my
Not
opinion,
at all?
Not at all.
Okay.
Because especially for 2017, if you're speaking about some periods, I know it's a little aggressive, little contrarian, but I don't see merit of having debt in the portfolio currently, if you have to maximize the return. If that's the objective, and you're keeping the objectives and goal setting, which is the conventional mindset of personal finance, aside for a minute. So if you come to that, equity 100%. If equity is 100%, if you have to take more risk, people, immediately what comes to people's mind is, let's play sectors. But I think that's the most inefficient way of taking risk. But taking risk in a more diversified fashion, in a smaller company's fund, will pay off significantly better than choosing the sector yourself. Now, there are some smaller companies fund which actually pack the portfolio with potential mid and large cap, and they've done it time and again. So I would choose 40-50% in smaller and mid cap companies, which will actually propel and will substantiate the risk taken in the portfolio.
So now this is such a teaser. I will ask you for the fund names right now itself. So do advise on some funds that you think could be good performers in 2017.
See, I think in the micro cap category, Nagnath, who's the CIO of DSP, has shown fair bit of confidence and has been able to deliver. So DSP Microcap is one of the favorite funds from a microcap perspective, because he's picked up stocks early in the past, much before they have been known to the market. And the second one will be a Franklin Smaller Companies Fund. If you put 20% of your money in these two funds, which will increase the risk, of course, but will give you a commensurate return, which justifies the risk taken.
So this would be the most aggressive part of someone's mutual fund portfolio. What about the slightly more stable names? You know, the aspect of bringing a bit of stability to your portfolio.
Yeah, again, the good news is the large cap indices have not run away too much anyway.
The market's been absolutely flat in 2016, yeah.
Absolutely. So having an anchor to your portfolio which will bring stability makes perfect sense. So I think if you had two large cap or three large cap funds, which again have had huge excess returns over and above the market, then in that category I will say Shankaran Narain, who's ICICI CIO, in his schemes has been able to do immense justice. So
which
ICICI Focused Blue Chip Fund, or the new fund which he thinks very confident about is the ICICI Top 100 Fund, which he thinks is the 2017. I had a very close conversation with him. So I would say ICICI Prudential Top 100 would be the fund of the future, and Franklin Prima Fund, Prima Plus Fund, and Birla Frontline. These five funds to put together
large
could be
cap equity funds.
Yes.
Okay, fair point. We'll take a break on that note. On the other side, the conversation continues. More products for 2017. Insurance, the kind of policies that you might want to keep in mind, and of course debt funds. Is there something still out there that perhaps can fetch you better returns than that fixed deposit? We'll come right back.